ConocoPhillips remains one of Leo Mariani's top picks in the oil patch. He's a senior energy research analyst at Roth, and he joins us now. Leo, thanks for joining us. I mean, these headlines, we suspected job cuts were coming. Conoco talked in January about job cuts. These were, I think, larger than at least I expected. What about you, and does it change the way you view the company?
Yeah, so look, I think to some extent, some of the job cuts should have been anticipated. On their second quarter earnings call in early August, they highlighted a plan to cut about $1 billion of costs from the business. And this is going to be spread out over several areas, and G&A was one of those areas. So certainly I expected to see some cuts coming from the company. But look, I think you're correct that the 25% number certainly jumps out at you, and the magnitude was probably a little higher than I expected here.
Well, my first take was, is this some kind of a read into what Ryan Lance and his team there see with the oil and gas market? Do they see continued lower prices, so they got to get ahead of it by lowering costs? What do you think?
I think that certainly could be part of it. But I think one of the other key aspects of this is that, look, a lot of companies are really starting to embrace technology across the sector. And a lot of this is sort of process-driven AI type of initiatives. And I think a lot of these companies realize that they can get away with less staff to still execute their plans over time. So I think it's a combination of sort of the lower price environment that we're in, which is always a good time to sharpen the pencil and cut costs, as well as the fact I think new technology is allowing them to do more with less going forward.
Yeah, and they certainly are trying. It's not, ConocoPhillips not the only name you like. I want to talk about two other names, Leo, that you like that don't get very much attention at all. One of them is California Resources Corporation. I got news for all my friends on the West Coast. California still produces oil. This company, very carbon intensive. I met the CEO last year, or they're trying to eliminate carbon. The CEO, as a kid, used to walk over from Mexico to go to school in the United States. Hardworking guy. This is a company that flies under the radar for most investors, but not you. What do you see in it?
Yeah, look, so you're absolutely right. Clearly a smaller cap company out there in the energy sector. But if you look at the stock's actually done quite well in what's been a very tough energy tape here in 2025. So I think you hit some of the points already, but this company is a significant oil producer and natural gas producer in the state of California. They are trying to pivot to get into other businesses, which include carbon capture. They are looking to be the first company that is able to sequester carbon underground, and they expect to be doing that early next year. They also own a power plant, and they're attempting to co-locate some data centers on that in the state. And they also have significant real estate value they're going to unlock longer term. So I think this is a interesting company because it certainly is an oil play, but you have some other businesses as well that can also create significant value over time. And then additionally, there's a sort of a movement in the California legislature for some oil and gas permitting reform that could really open up the state to more drilling over the next several years.
Yeah, it's amazing. We got to go. We showed some of your picks, Leo. I talked to the CEO last year, and I said, how do you operate in California? He said, listen, it's tougher, but they realize they will need oil and they will need gas. They can't have $10 gallon gasoline because ultimately some of these politicians, I suspect, once you get reelected, we'll see California Resources up a little bit today. Leo Mariani, Roth Capital. Really appreciate it, Leo. Thank you.